Welcome, everyone. We are all here to deep dive into all things Polysign. For those that don't know, it's a company that's built really transformative financial tech that provides institutional investors with blockchain-enabled infrastructure in support of digital assets across both the capital markets and payment sector. We're talking really critical tech in helping accelerate the transition from traditional finance to decentralized finance. Custody is kind of the foundation that underpins the management and safekeeping of digital assets. It's the sort of the glue that brings the broader crypto industry together, and we are all here to find out more. So it is a great pleasure to welcome Jack McDonald, the CEO of Polysign. Prior to Polysign, he was CEO at Conifer Financial Services for a decade. There he grew assets under management from $5 billion to $125 billion, culminating in an exit in 2016. Prior to Conifer, he served as MD and head of West Coast equities at UBS. He was named one of the 20 rising stars of hedge funds by Institutional Investor magazine and inducted into Global Custodians Legends of the Industry. So welcome, Jack. I'm also now going to hand over the reins to our very own COO, Joe Indoso, who really needs no introduction. So Joe, over to you to kick this whole thing off.
Thank you so much, Irene. Jack, we're really privileged to be in your company today. We've got so many of our folks very excited to hear and learn more about Polysign. We've explained to everybody, and as Irene had said, what you're doing there is building infrastructure that is absolutely necessary for mainstream institutions to adopt digital assets as an investment class. And, to a lot of folks that may seem almost like a boring use case, but we are really excited because we think not only is it very technically challenging to be building what you're building, but we also understand that it's got profound implications, not just on the future of digital assets, but the future of capital markets as a whole. So this morning, Jack, I'd like for you to shed more light on Polysign's mission, what you've achieved so far with the company, and what significant developments you see over the horizon. Let's kick off by maybe you sharing Polysign's genesis story. How was the company started? What was the rationale behind it? What did you guys from the earliest days feel you wanted to do?
Yeah, that's great. And before I answer that, first, I just want to say thank you for the opportunity to be here this morning. Irene, if you ever decide to, give up your day job and want to come join the marketing and strategy team over at Polysign, we'd love to have you. So, love the enthusiastic intro there, and you get it. You get the core function of what we're doing. So I'm really excited, just as an aside, to be a part of the Linkto family. I candidly did not know much about Linkto up until about 6 or 8 weeks ago, and I've really enjoyed getting to know you, Joe, and the rest of the team. And as we've been pushing ahead towards how we might be able to work together outside of simply an investor on our cap table, quite excited about what I'm learning in terms of your own mission, and look forward to continuing those conversations. Polysign, let me just maybe orient everybody. I've got my standard custody logo over my shoulder here in my fake virtual office that often people think, are you really there? It looks like a cool office. We do have cool things going on, but Polysign is the parent company where all of our equity has been raised. Polysign was started about 4 years ago by Arthur Brito. I'll tell you the story there. We have a couple different subsidiary organizations that are 100% owned by Polysign. So as a investor in Polysign, you own the same equity that I own. We own 100% of these different subsidiaries, as well as all of the IP. So the way you can think about the corporate structure, and I'm sorry not to address the question head on, Joe, I just want to orient people for a moment.
Sure.
Polysign owns all the IP, parent company of 2 different subsidiaries right now. One of them is Standard Custody and Trust, which is our New York qualified custodian. We can talk a little bit more about that later, what that means, but it's a very coveted license to have from the highest regulator in the land to be a qualified custodian for digital assets. And then more recently, we bought the leading fund administrator in this space, digital assets, called MG Stover. That business has, I think, 120 clients or so, about 35 billion of assets under administration. Very symbiotic relationship between custody and fund administration, in the same way that the BNY Mellons and State Streets of the world think about this. And so we were not actively looking to buy an administrator when the opportunity came along. They are by far the number one in the space, but that opportunity, when it comes, you have to pay attention to. And so we were very excited to acquire that asset. And then we've got a third project, I'll call it right now, a little bit of a skunkworks campaign, building a broad-based settlement layer, also powered by a proprietary blockchain, just as our custody business is. We're currently calling that Polynet, and I think that could have some very interesting implications for what you are doing in the kind of private company investment platform, and your mission to democratize, as I understand it, to democratize finance and to allow more retail-oriented investors to come into private company investing. So those are the three underlying businesses, parent companies. So why did we start Polysign, and what's the story there? Arthur Brito was one of the three co-founders of a company called Ripple, which has been around for 10 years. They are in the news of late in that they are at the crosshairs of an SEC investigation. It's a good thing, I think, around whether or not the sale of a specific cryptocurrency called XRP is deemed to be a security or not. And they have spent, I heard the CEO speak last week, Brad Garlinghouse, at an event, and they have spent $100 million fighting the SEC on this, and just recently have filed summary judgment motions to determine whether or not they're going to ultimately prevail. I mention that because it's a very leading company in the cryptocurrency and digital asset space. That business basically is premised on building cross-border rails for financial institutions to exchange value. And Arthur Brito was really the core mastermind of building the technology for that company. Fast forward, Arthur left after, I think, about 6 years or so, because he wanted to focus on other projects and initiatives. And a fellow investor in Ripple came and asked him to consider starting a custody business, because at the time there were really very few custody businesses for digital assets that would meet any sort of institutional demand or threshold. Let me just pause that for a moment. I had been running, as Irene had mentioned, a company called Conifer that had both a broker-dealer and we did custody and trading, and a fund administration business. So also puts into perspective why we've done what we've just done, and this is a model that I'm familiar with. After the successful exits of Conifer, we split the business. We sold a broker-dealer to Cowen and Company. We sold the fund administration business to SS&C. I was looking to do something else, and met Arthur through an investor who turned out to be one of the seed investors in Polysign, who suggested that I meet Arthur to hear his vision for the company and to see if I'd be interested in helping him. Arthur is a world expert when it comes to cryptography and blockchain technology. I know a thing or two about capital markets, and so we decided basically to lock arms and start this business together, really to bring forth an institutional grade platform that would allow institutions to ultimately invest and safeguard their assets in the digital asset industry. We wanted to focus first on capital markets, though a lot of what we're building is very relevant to the global payments business, and Arthur has a lot of experience there. We wanted specifically to be a qualified custodian, which is a requirement for any institution in the US managing more than 150 million of regulatory capital. And in the traditional world, you could either be a broker-dealer regulated by FINRA, you can be a futures commodity merchant regulated by the CFTC, or you can be a trust bank regulated on a state-by-state basis. In digital assets, FINRA has not allowed any broker-dealers to custody digital assets, so that's not an option. if you only want to support and warehouse futures, you could certainly get a CFTC license and be a futures commodity merchant. But if you wanted to support a broad range of digital assets, you have to become a trust company. And so we went to the highest regulator in the land, New York, and got that trust company license a little over a year ago. So let me just pause. That was a long answer to your question, but I thought it'd be helpful just to give some context at the outset.
That's great. It's a good maybe segue to one of the questions I had, Jack, which is that you had made the point that prior to Polysign, you pretty much spent your whole professional life in the traditional finance world, right? You were in investment banking, investment services of one type or another. What was it in that conversation with Arthur that made you decide to shift to this digital asset world? And maybe now that you've had experience operating a blockchain company, what are some of the more important things you learned in the TradFi world that you're now bringing into digital assets and Polysign?
It's an excellent question. I think, and I will confess, I could wing it, maybe, to tell you the difference between blockchain and Bitcoin at the time I joined Arthur to start. But just being a student of the TradFi industry, certainly felt like there was an enormous amount of friction in the industry that the incumbents are loath to really change, because that friction allows a lot of middlemen, if you will, to use the expression, to have their hands in the cookie jar and to make a living off T+2 settlement. For example, when the technology I knew existed for instant settlement, and having a sense of the PayPals and the Venmos of the world working a whole lot quicker and faster than going down and writing a check or taking out money from your local bank branch and walking across town and handing it to Joe. If I could just Venmo him or PayPal him instantaneously to the user experience, even though there's still some friction at the back end there, that was exciting to me. And I had a belief that less about cryptocurrency, but it was more about the underlying technology and blockchain, that there would be this evolutionary sort of integration between the old and the new world that would have a profound impact. And some really smart people that I met in that journey were focusing on this space. Specifically, Arthur, as I learned more about him, I just thought it was fascinating, and the opportunity to work with him I thought would be really unique, and I would learn a ton. I also met in that courting phase a fellow by the name of Tim Keeney, who ran all asset services globally for BNY Mellon for about 10 years or 12 years. And he had agreed to be on our board. Literally, they were, at the time of his retirement from BNY Mellon, they were the largest custodian in the world, I think responsible for custodying some crazy number, like 26 or 28% of the world's assets. And so he very much understands the importance of custody, but also the surround sound of other services like fund administration that he was responsible for at BNY Mellon, and I had some connectivity to at Conifer. And so I thought this was just too great of an opportunity. And looking back on it, I thought it would be a very binary sort of outcome, and that within a year or two, I would know that it was either going to be a rocket ship or it would be a dud. And here I am 4 years later, and I'm have more conviction that it's going to be a rocket ship, but it's taken time to play itself out. This whole industry, I think, has gone through a little bit of a fits and starts around the thesis that institutions are plowing into the space and they're going to really transform digital assets as we know, and that stampede of digital assets or of investors coming into the space, I think, has been slow and steady, but it's been less intense than many had hoped for or projected. And we can talk a little bit about, kind of where we are in the uptake of the industry.
Yeah.
In terms of lessons,
go ahead.
I was going to say, a couple of the lessons learned that were, I think, hunches that I had when we started that have been reaffirmed. Number one, the importance of custody. It's really, really important, and Irene mentioned at the outset that everything around asset servicing really starts with custody. And so there's a lot of attention being placed on custody. Having a license around that and being a regulated entity is also very important. You know, I think of what we're doing in the industry that Polysign sits in, is we are really rewiring a new operating system for capital markets. And there are players that are regulated and there are players that are not. There's smaller companies, larger companies. We've taken the path of being conflict-free, i.e. we don't want to be an exchange and a custodian at the same time, because we're somewhat tethered to the old world roles that institutions have. Gary Gensler seems to see it our way. He's spoken repeatedly about that segregation of duties between exchanges and custodians, as opposed to a Coinbase or a Gemini that actually have kind of a joint model to them. It's not per se wrong, it's just a belief we have that there will be that segregation of duties. We think regulation and being licensed is really important. We welcome regulation. It's a lesson from the old world, if you will, that I think is going to be very important as institutions wade into this space. I also think a lesson around the underlying technology and the importance of settlement, but our ability to provide a settlement and a custody solution that is built upon a proprietary blockchain, I think is going to address a lot of the inefficiencies that help to make a living for all of us in the old traditional finance world. I think it's going to be really profound, the impact that has in this new world order over time.
Amen to everything you've said, Jack. Starting, by the way, with your statement about, you know, custody. So, I mean, it's clearly an important impetus for the discussion we want to have with you about being our custody partner, because we're now call it 153 million or so in assets as of this morning, and growing by the day. And at a certain point, despite the fact that these are not level 1 assets in our private restricted stock, that need for custody, and especially if we have regulated institutional partners working their channels with us, that custody requirement is going to become ever more important. And when the day comes where we turn on our blockchain implementation and we digitize all of these investments that our members are making into securities tokens, by golly, at that point, it'll be absolutely impossible to operate without, you know, a good crypto custodian, right?
Right.
Purely for operational reasons, never mind regulation. So
Sure.
I'm super excited at what you guys are building, and I think it is going to be critical to the future of companies like Link2 and everybody else in the market space.
That's great.
Having said that, you know, you've been in the trenches for 4 years, right? You've obviously had more than your lion's share of talking to institutions about the story and why Polysign can help them make that leap into this new class of assets. What have you learned in terms of maybe the biggest hurdles to full-on institutional adoption of digital assets?
I think there's 3 factors that institutions, buy-side institutions, are weighing that they need to get comfortable with before they'll invest meaningfully. And I should say I was on a panel with someone at the Mainnet conference on Friday in New York, and the topic was institutional adoption, specifically of DeFi, decentralized finance. And as you'd expect at a lot of these conferences, people talk their own book, and she was saying that they've onboarded over 250 or 300 institutions to their product. And I asked how she defined an institution, and she said any organization with more than 1 person. So that's not my definition of an institution, just to come back. You know, we talk institutions that could range from organizations like yourself, pensions, endowments, hedge funds, could be a private equity firm, or fund that invests in private companies. Those are the sort of, you know, it could be RIAs, multifamily offices or family offices, but it's not 2 guys in a garage. I think the 3 factors that are constantly being reviewed by these institutions in no particular order of importance, first and foremost, are education, understanding how digital assets work, what the risks are, what the benefits are, really wrapping your head around it. Second, and very much related to that, are regulatory concerns. It's still unclear what the taxonomy of all these different assets are. Are they securities? Are they commodities? Are they currencies? Are they other? And the regulators are not helping us gain any clarity on that. There's kind of cryptic messages that come out from time to time, or vague messages saying, well, Bitcoin is a commodity and Ethereum likely is, but there's no guidance on the rest of classifications for these assets. And that's the fight, by the way, that Ripple is fighting on behalf of the industry. They've got the resources that most don't to really take this all the way to the top against the SEC and fight for clarity on whether or not these assets are deemed to be securities or not. And if so, does the Howey test, which is 75 years old, does that still apply? Or should there be different considerations and a different lens through which you analyze these assets? So education first, regulatory clarity second, and then the third is infrastructure, which is the pond that we're fishing in, if you will, where institutions, even if you get comfortable with the asset class and say, all right, we're going to start to buy some Bitcoin in our fund, and we're comfortable around the licensing of that and the regulatory considerations, do we as a large organization have confidence in the infrastructure? And if I have to go into a completely different architecture to invest in these assets, is it worth it? Does it create operational risk that we're not comfortable with, et cetera? We're used to dealing, for example, with the segregation of duty between exchanges and custodians. We custody with BNY Mellon or State Street or Goldman Sachs. We execute at the NASDAQ and we execute at the New York Stock Exchange and the FTSE overseas. We're used to T+2 settlement. We're used to tax reporting. We're used to a fund administrator who understands the assets. We understand how the audit process works, all those sort of things. Here's our order management system. Here's how trade entry gets done. And all of a sudden, now I go into this market where if I buy IBM, I go to my Bloomberg machine at the end of the day at 4:01 p.m. Eastern time, and there's only one price for what IBM closed at on the New York Stock Exchange. The only place I can buy it is on the New York Stock Exchange. We all agree what it's worth today. Simple, straightforward, standardized. Bitcoin, you can buy Bitcoin 24/7 at exchanges all over the world. There might be 80 or 90 different exchanges that you can buy. Each one of those exchanges has a different price. And what price are you going to take that's going to trickle down into your fund? What are you going to tell your auditor at the end of the year, et cetera? So there are all sorts of different considerations, not to mention the fact that to buy your Bitcoin, as opposed to IBM, where you call up your broker, you say, I want to buy 1,000 shares of IBM, and you've got today trade date +2 in order to deliver your currency to purchase the shares. And the seller has today trade date +2 to deliver the shares, and then you clear and settle the trade. When I buy my Bitcoin, I have to pre-fund the account at the exchange. So I go to Coinbase and say, all right, I'm going to buy 100 shares of Bitcoin today. I have to get my money to the exchange before the transaction happens. The seller has to move the shares out of their custodian, unless they're at Coinbase, to the exchange, and then we instantly settle that trade. So it's a very, very different operational flow. And our view at Polysign for both standard custody and MG Stover is to streamline that process as much as possible, because we believe that institutions will evolve. We preach evolution, not revolution. And to the extent that we can build systems that integrate with their current systems, to the extent that we can work with their current service providers, auditors, other custodians, other fund administrators, lawyers, et cetera, we want to do that because we want to lower the barrier that it's going to take for institutions to get comfortable. We have a lot of institutional pedigree and DNA in our leadership team. We come from this perfect balance, we think, between the TradFi expertise, people like Tim Keeney, myself, and then you've got the digital asset cryptography, blockchain expertise. Arthur Brito, I should have mentioned David Schwartz, who's a leading cryptographer. He's the chief cryptographer at Ripple. He's on our board. He's an advisor. So we really have this blend of talent that we believe is very unique in the industry.
It's interesting as you describe some of the elements of infrastructure, right, that populate the traditional capital markets today, Jack. How if you're going to be evolutionary and not revolutionary, and you've got to take some of those things, make them much more efficient using blockchain technology, but not necessarily supplant them or replace them, right? There might be other things, though, that will be replaced, like T+2 settlement, right? Which doesn't have to be T+2. And with the right kinds of linkages, you can do atomic settlements on chain and instantaneously settle without incurring any form of counterparty risk, right? On that clearing and settlement process. So as you look at that broad landscape, clearly you're saying, okay, custody, that's an old world thing, but that's something we can carry over into the new world. What other things do you think get carried over, and what things get killed?
I think that's a really good question. Well, let me just tell you my knee-jerk reaction, which is not relevant to Polysign, but I can't stand title insurance. It drives me crazy. You know, we have a home, we bank with First Republic, we have our mortgage there, we did some construction, had to move to a construction loan. So we had to refinance, even though it stayed within the walled garden of First Republic. It's not First Republic's fault. I had to go back to Chicago Title, pay an extra $5,000 or $10,000 for them to affirm what we already know, that First Republic and I own the home. We do our construction, then we convert it back to a traditional mortgage, and I have to go back to Chicago Title to confirm what we already know, which is I still own the home with First Republic. And each time, you know, $10,000, you know, racks up. Whereas if that was all stored on a blockchain, the title, anybody could go to the county clerk website and see if there's any liens on it, and it would just live in this immutable golden copy of the truth. We really, and I think blockchain technology replaces trust with truth. And so if you think about that just as a corollary into capital markets, cap table management, you know, will be transformed in terms of how data lives on a blockchain. I think the whole settlement process will shrink over time, whether we get to instant settlement. I think it's inevitable, we have to, but there's a lot of incumbents who don't want that to happen. I think a lot of the record keeping that's manual goes away because it's going to live on chain. I think that a lot of the treasury and collateral management processes will be made much more efficient because one will be able to see, you know, I think the ability to pledge assets, the same asset, to various places that have brought down, you know, hedge funds and banks, you know, from time to time. I think that will that risk will be materially compressed. If I've got, you know, 10 stocks in my portfolio, and if I pledge them to Goldman Sachs, that should live on a chain, so Deutsche Bank wouldn't be suckered into making the same you know, transaction or loan against a security that's already been pledged somewhere else. That transparency is really critical. But custody as a function remains, absolutely, because you have to more than ever store these assets securely. And I think that fund administration also will always remain the same, because there needs to be an accounting and reporting to investors for pooled vehicles, whether it's a hedge fund or a private equity fund, et cetera.
But it's going to be much more cutting edge, modern custody and fund management administration, because you're going to have tools that don't exist in the TradFi world, which are provided to you by the new world.
That's right.
Of blockchain technology. So, for example, solving the problem of rehypothecation of assets, right? You can solve that much more cleanly and easily through immutable ledgers.
No question about it.
I completely get that. Yeah.
We also think about just the subscription process coming into a fund, and you think about linked to, if I have, and this is not far away from the technology being able to deliver it, whether or not the markets embrace it, but think of this notion of a global wallet, a global ID that is my digital passport, that I can do a lot of things with. I control access to it. I control delegation of signing authority. If I came and wanted to invest in the Link2 platform and had just had a digital ID, think about how many processes that could be somewhat cumbersome or manual today for you would be ameliorated, and how much smoother that process would be. And rather than having to go sign subscription docs at all the different private investments I make, if I have this one uniform passport that attests that I am who I say I am, that gives delegation of duty for different things to different people or different organizations, that would just materially streamline what is a manual process today, what's rife with errors from fat fingers, et cetera. And I think it's just one area where we're going to see parts of our business, even just in terms of the onboarding, the subscription, wire processing, a lot of those treasury services and investor services today are quite manual in nature, and they don't need to be.
Yeah. Do you see I assume that your revenue model today is still very much along the lines of traditional custody and fund management and administration, right? Do you see that revenue model changing as you evolve into newer types of product like the PolyNet product that you were alluding to?
I do. Today, we charge primarily basis points of assets under custody for the custody business, and the fund administration business is a similar basis point driven model. There are some more fixed fee engagements there to simplify. I think over time, we may consider licensing some of our software out. So that's part of our longer term strategic plan, to have 50% of our revenue 5 years from now to be in a licensed subscription model. And so that bodes well for more of a reoccurring revenue model. Today when you're charging basis points of assets, you kind of live and die by the sword, if you will. So in the boom years, it's great. In the bust years, not so great. And so that's one example. In the PolyNet, it's going to be a combination of a licensed software approach as well as a toll booth of sorts, where there will be a mechanism to charge on a more of a commission-like sort of structure on a transaction by transaction base. The more assets that settle on that network and chain, the more that we will be able to, somewhat tweak the revenue model there.
Yeah, that makes perfect sense. And what's, before I turn this over to Q&A, I've got to ask this question. What's the exit strategy for Polysign, or is it too early? I know you probably spend most of your day thinking about growing Polysign, not exiting, but.
Well, I think about the two. Yeah, no, I think about the two together. My job as a CEO is to create value for our shareholders. I have a slightly broader view that and the way I'm going to do that is by having a very positive, professionally stimulating, and culturally healthy organization for our employees, because I believe if we have happy employees, it starts with our employees, our human capital. And if you get that right, you'll have happy clients. And if you get that right, you'll have happy investors. And so I do think about this continuum. I'm on a happy brigade here, Joe, trying to make everybody happy. But I think
you're partnering with the right firm, because we share exactly that same outlook and values.
That's great. The exit strategy is to sell the company ultimately to, I think, another financial services firm, a strategic, that will finally eclipse the hurdle of saying we need to be in digital assets and make a decision that it's going to be quicker to buy versus build. This is difficult technology to build. And I think all the global asset servicing firms are going to be in this space. So the BNY Mellons, the State Streets of the world. Some of them are starting to experiment with the fund administration side of the business. They're not there yet. And nobody's there yet in custody in terms of the big guys. They're all looking at it. They're licensing software, they're building, but the regulators haven't yet allowed them to offer that service. But I think once that door opens, I think you'll see a consolidating phase and an M&A boom in the space, which is what I think the most likely exit for us would be. Clearly, you could go public. When the SPAC boom was a little bit brighter, we had some conversations inbound just so people wanted to know if that's an area that we would look to go. It seems premature for me right now to sell the company. We have a lot of value to build and a lot of opportunity to leverage, and so that's where our primary focus is right now.
Yeah. Oh, great. Irene, perhaps you can moderate some questions from our audience.
Yeah, thank you so much. So we have a question from Michael saying, how will RippleNet and PolyNet work together or apart?
So unclear at this point what support. So Ripple, full disclosure, they're an investor of ours. I love their business model. We've got a lot of DNA in the firm coming from Ripple, although just to be clear, Ripple's not on the board, they're not an advisor, they're not a controlling shareholder, but they've been supportive. And I continue to think, and we continue to explore ways that we may be able to support them, particularly on the custody side, which is one of the areas that we think a lot of the institutions that are taking advantage of RippleNet, who are trading and getting on-demand liquidity through using the rail system and using the bridge currency XRP, that we could be in position to support them either through our standard custody business or through a modification of that, where the end users of RippleNet could benefit from having a strategic custodial partner.
Great, thanks. Nick, I know you had a question. You raised your hand. Over to you.
Yes, thank you, Irene. Hi, Jack. Thank you so much for being here today. We really appreciate it. I work with our member investors every day, and they often ask me a lot of different questions about Polysign. I know David Schwartz has been on Twitter for years and always stressed that Polysign is in stealth mode. We're in stealth mode. We can't talk about it. But he always seemed so excited about it and wished he could talk about it, but wasn't able to. But a couple of questions I had was on the website. It talks about financial institutions leveraging digital assets. Also talks about transacting in digital assets across capital markets and payment sectors. Can you take us down to ground level and give us a couple of examples how your customers, what sort of services that you would provide your customers in relation to those things?
Yeah, well, on the payment side, again, think of us as a bit of a lockbox, first and foremost, and specifically within standard custody. What we're chartered to do is provide custody and escrow services for institutions. So we're less focused, and we don't have a solution today for a payment rail. But you can think about it, probably the best testament to the synergies between custody and payments would be what PayPal did in buying a firm called Curve a number of years ago. I think it was 2 years ago. And what Curve does is they essentially were a firm that had built what's called multi-party computing, which is essentially a sharding software. If you're familiar with private keys, you buy a digital asset, you get a key generator. Think of a 27-digit alphanumeric code. And you write that on a piece of paper and you break it into 3 pieces and store them in separate places. I'm simplifying it. There's an algorithm that does that. And there are a couple of firms a number of years ago who started businesses doing that. Curve being one, Fireblocks, which is a quite successful company in the space. More recently, Copper in the UK. And there's another firm that was recently acquired by Coinbase, Unbound. And that's the business that they were in. We viewed that as critical technology to have as part of our solution. We have a multifaceted approach. We haven't spoken much about this, but we have a blockchain at our core that Arthur and David designed. That MPC computing part of it, Arthur and David, I introduced them to all the companies and they rubbed their chin and said, I think we can do this better ourselves. And so we built our own algorithm that does that key sharding. PayPal, just getting back to your question, wanted to own that because they envisioned building out this digital component to their payments business. But critical, whereas in the traditional fiat currency world, where the payments are US dollars or the euro or whatnot, traditional institutions can warehouse the currency or custody the currency. When you move into a digital asset space, you can't go to BNY Mellon or Wells Fargo and say, can you hold my Bitcoin? And so they needed another solution. They could have hired us to be their default custodian. We had conversations around them, or they could have built their own, which is essentially what they've done. And they bought one of the leading software providers to be a critical ingredient. So point is, payments businesses do require a form of custody. And if you think about a lot of the, and Ripple's has a core focus on global remittances, which are smaller payments, more frequent transactions, you know, the Philippine fisherman who wants to send money to his cousin in Spain, you know, how does that happen? You know, it might be $50, the equivalent. You know, the idea of going to a bank, getting a wire, sending it across town, like you just spent $40 on your wire for a $50 payment. It's going to take 3 days. There's an error rate. Don't really know when it gets there. The recipient has to go to a bank. You know, it's messy. Quicker to get the money, put it in your suitcase, fly there. Obviously, a little more expensive. But through Ripple, you could do it instantaneously and at a fraction of a penny. And so we're bullish on global payments. We're bullish on the whole remittance business. And you know, we have not yet really built out a solution specifically targeting that, but it would be some way, shape, or form having something to do with our custody and or settlement technology that we're building.
Appreciate that, Jack. One other question before Irene asks the others. It's our understanding that Polysign has 200 plus customers currently. Are you able to give us any names of any of your customers? Are you able to release any of those bigger names that our investors might be aware of?
Yeah, we don't release any of the names just for security reasons on the custody, right? So, you know, some of them are big names and they don't want to be targeted or, you know, in the same way that, you know, customers don't say where their assets are held, sort of thing. On the fund administration side, I probably shouldn't say that just because I don't have permission to, but I can tell you on the fund administration side, they are, if you looked at the top 10 leading digital asset investors, I think we're supporting 8 of the top 10.
That helps us. Appreciate that, Jack. Thank you.
You bet.
Thanks, Nick. We have a bunch of questions, but I have one that I just wanted to touch upon, which you basically just mentioned, which is the blockchain at the core. And I wanted you to talk a little bit more regarding standard custody, which is obviously the only custodian to utilize third-party transaction verification and build its platform on a combination of smart hardware, security modules, and novel blockchain tech. So I think I read that you once said that makes it kind of better than cold storage. So for those that don't understand the space well, can you kind of explain in layman terms the significance of this? Because it's actually kind of a big deal.
It is a big deal. I will try to differentiate back up in the industry, maybe 5 years ago, let's just say, or 7 years ago, which seems like a lifetime. Storage, and I reference back to, you buy a Bitcoin, you get this key, and that is your proof of ownership. It's a bearer instrument. So it goes back to, you know, there is one stock certificate, and if I take it out of Nick's hands, now it's mine, now I own the stock. And if Joe takes it from me, he's got like, you can't say, hey, Joe took my stock certificate, and there would be a ledger over here say, yeah, that's right, Jack owns it. In the case of crypto, it's a bearer instrument. So that access to that key is really super important because that is your proof of ownership. And all transfers are irreversible. Now, the benefit is you have this blockchain that essentially is otherwise known as a distributed ledger technology that stores in an immutable way blocks of information that can never be reversed. So there's no revisionist history going on in this industry either. In the early days of storage, there were 2 different types, hot and cold. And cold storage referred to a mechanism of storing those private keys in a way that was completely offline. And in the extreme cases, and one of the first institutional custodians literally had machines that stored the information that were not on the internet, they were not online, they were just kind of plugged into the wall, and they were literally housed in bunkers in Switzerland with like armed guards there. And nobody would know where it is. And if you found out where it is, and if you broke in and got past the guard and got into the cage and, you know, took the machine out, you could theoretically find the keys. Or other people have had them in like the satellites or whatever. That's great, maybe. It's great because they are super safe. There's also a bit of a zero or single point of failure, because if I know where your bunker is and I
Right.
bomb your bunker, you're kind of out of luck. And the industry has obviously evolved since then. The other challenge with it is going back to what I said about pre-funding. If Bitcoin miraculously today goes from $20,000 to $50,000, and you say, great, I want to sell it, it's going to take some time to go to the bunker, get your key out of the bunker, walk back, put it at the exchange and trade that. So it's not a particularly practical solution either. And so what we've come up with is a way to do that through this key sharding software, which I mentioned, the MPC. We store it in a series of hardware servers, for want of a better term, called hardware security modules, that are stored at different co-location facilities, different vendors all around the world, and different machines, and they go in clusters. And so you have to have these different HSMs essentially coming together to agree a transaction and to move it. All of that, and these machines, hardware security modules, self-destruct if you try to tamper with them. So you take a screwdriver to it, it's like James Bond kind of stuff, it blows up. And which is okay because we've got other HSMs that can come together. So there's no single point of failure. And the beauty of the blockchain is it runs that multi-party computing and the business logic through to store in the HSMs. So another core feature, I'm looking at the four of you right now. You have an organization, it's Linkto's crypto holdings. You will have quorum levels of approval. So Joe can't just decide to move all the Bitcoin from this address to that address because he might be stealing it. So he's got to get 2 of 4 signatures or 3 of 5 signatures that also support that transaction, and all that business logic as well is stored in our blockchain. So the regulators love it. It's a differentiated kind of belt and suspender approach. The insurers love it because it adds a different layer of security. And it also allows us to do a lot more machine to machine transaction processing without the risk of human intervention, which slows things down. We're the most secure, but we're also the fastest. And it also mitigates the risk of collusion because no one human being can essentially change that process or deter what the signatories would otherwise have directed.
Yeah. I might add, Jack, that after we did our very first technical review, our engineering team and your guys, not only were we impressed with the fact that you had the MPC framework, but the consensus protocol that brings all of that together and to validate on the ledger, that consensus protocol that you guys have incorporates parties that are party to the transaction itself and you guys as the platform party, but third-party validators that have anything to do with a transaction, right?
Right.
And we thought that was really neat. Yeah.
So we have a bunch of other questions. One is from an anonymous attendee, and the question is standard custody and/or Polysign going to help solve the naked short problems in the securities markets? Is that one of the avenues of the business?
Not something we're currently focused on. That would, I think, well, I take that back. There is, the answer to that is actually yes, from a standpoint of something that we're doing around an escrow feature where this requires some permissions and some integration. We have a strategic partner in Cowen Digital, the investment bank. If you are a hedge fund, let's just say you've got a trading relationship with Cowen, you've got a custody relationship with Standard Custody, we built something we call a look and lock, that if you give Cowen permission to see what's in your vault, you call Cowen and say, trade right here 50 Bitcoin and sell it for me. You would otherwise have to move it to the exchange to sell it and move it out of our storage. It's going to take you 5 minutes, you're on the road or whatever. You give Cowen permission to essentially lock that asset. They go out and sell it, and you would settle later that day or next day or whatever you agree to with them. But for that ability to lock the asset essentially in an escrow vault, Cowen would be naked on that short. So there's a nuance to it. I don't know if that was the context of the question, but wearing a custodial hat, there are things we can do to help solve that problem. And it's really important because of the bare nature of the asset.
Great. Kelly is asking, will Polysign custody assets for the retail investor? Will they custody DeFi assets such as Flare, including all of Flare's assets?
We do not support retail customers. Our threshold that we've been licensed for are accredited investors. So there could be some retail investors that are accredited investors that could theoretically have an account with us. And we will be custodying different DeFi assets than we are today.
Okay, then we've got another question.
And Flare is on our list. We're not currently, but it's on our roadmap.
Okay. Is the Polynet coin crypto asset going to be made available for purchase on the public markets?
It's a ways away, but ultimately the answer to that would be yes. But as maybe some regulator might be watching this, we got a lot of wood to chop around ultimately bringing Polynet. Version 1 will not have a native token to it, but the longer term plan is ultimately to have a token. We have a lot of work to do in terms of structuring it to determine whether or not it will be a security or not. And if it's deemed to be a security, or if we believe it to be a security, we will absolutely register it as such and comply with all the laws of the land.
Jerry is asking, why, when would a financial institution decide to build custody into their framework versus buying custody as a service? For example, NASDAQ comes to mind as they just announced their digital asset business. How can Polysign compete in an arena where larger institutions are willing to build and offer it all soup to nuts?
So I think it's going to become a speed to market sort of decision that a lot of the bigger banks would do. Bigger banks want to ultimately own custody because it's core to what they do. You know, BNY Mellon, State Street, Northern Trust, they're custodians first, and then they've got all these businesses that evolve on top of it. So, and we've talked to, you know, most of the big banks, they ultimately want to have their own solution. The question is whether they buy someone like Standard Custody and then build upon it or start from scratch. And I can tell you the technology, it's taken us 4 years to build it with the brightest minds. It's not something that your IT team at State Street just decides to up and do. Hiring the talent to build this is tough. It's tough as a startup in Silicon Valley. We are able to attract the type of engineers who want to work at startups. Generally speaking, that same type of engineer does not want to go work for a big bank. And I think it's going to take the big banks a while to get there. And when this tide turns and the institutions are stampeding in, they're going to want to be there quick. And I think that will dictate a different approach from a strategic M&A standpoint for them. It's my view.
Yep.
Okay. We've got time for 2 more questions. Chris is asking, any chance Jack can talk about their valuation?
Sorry, I cannot disclose that. Next question.
Lily is Lily, I know you're on screen, and I thought you might want to jump in and ask a question.
Yeah, Jack, thank you so much for sharing your thoughts with us today. And I'm on the board of Link2. I love the way you pronounce Link2. So I'm going to start using that Link2 from now on.
I heard Joe say Link2, so I got it right in the second half. I apologize.
Joe is thinking about developing some cryptos for Link2. So I love that pronunciation. But when I've been on the screen for a while, you sort of already answered my questions. I was asking you how the big guys, how you differentiate from other newcomers in this space and how you compete with the big guys. You mentioned that Wells Fargo already have their own custodian system. So how do you compete? How do you differentiate yourself with others?
Well, none of the traditional banks have a solution yet because they are at their core, they're either broker dealers, and FINRA has not allowed them to do it, or they are GSIFIs, globally systemically important financial institutions that require Fed approval. So to date, we have not seen the Goldman Sachs, Morgan Stanley, or the Wells Fargo cities offer a custody solution. They're all looking at it, building it, but they're not live in the market. The other big folks that we compete with, the Coinbase of the world, Fidelity has an offering in a separate subsidiary. Coinbase is Coinbase. Everybody starts with them. We've got some, I think, differentiators in terms of our service levels. We are also conflict-free. They're an exchange, they're a market maker, they're a broker, they are a lender, they're retail, they're institutional, they're custody, they're an exchange all in one. Some people don't like that. We're just custody. So that's an easy demarcation. folks like Fidelity only support Bitcoin. We support 30 different assets. So there are differentiators there. And it's not a situation, I think, where you'll have kind of a one size fits all. I think just like hedge funds today or asset managers have multiple prime brokers and custodians they use, I think so too. Will that be the case in the digital asset arena?
So do you have competitors already that you are aware of?
Oh, absolutely. Oh, yeah.
Okay. Can you name a couple?
Sure. So we compete with Coinbase. There's a firm called BitGo, which was one of the earlier ones. There's a firm out here called Anchorage that we compete with. And so.
But Jack is a lot nicer than Mike Belshie, and we would never partner with BitGo for that reason.
So thank you, Jack. Thank you, Joe. So Lily, to your naming rights, we're actually going to keep it linked to Polysign. Right.
Yeah.
So eventually we'll have linked to Polysign.
I like it.
Jack, Joe, you get the opportunity to ask the last question, and then Jack, if you close us out after this, we would like to keep us on track on time. Thank you.
I'm rather than ask a question, I'm just going to bring up a piece of trivia that I think might at least be peripherally relevant here, which is that like Jack, I'm kind of new to blockchain, coming from the TradFi world and a student of it. But I'm also, for those of you guys that know me well, you know this, I'm also a student of rock and roll. And this year is the 50th anniversary, actually, of a landmark record that the Rolling Stones put out called Exile from Main Street. And I was thinking about that, and I was thinking that's what Jack is. He's an exile. He's actually exiled from Wall Street. And boy, are we lucky to have Jack as an exile from Wall Street in our ranks. So with that, I just want to again thank Jack so much for spending an hour with us. And if he doesn't mind, I'm going to have Keith Richards and Mick Jagger just take us all out.
Yeah, love it. Well, thank you very much.
You know that you can make a full-time income from YouTube without ever trying to grow your own channel?
Thank you, Jack.
Thank you.
Really appreciate it.
Thank you, Jack.
Thank you. It's fun.
Thank you, Jack. Thank you all.
Thank you.
Thank you, Irene. Great job.
Thank you.
I love the Stones too. Can't turn it off.
Oh, there you go. We grab a beer together and listen to it.
You got it. All right. Thanks, guys.
Take care. Thank you, everybody. Thank you.